Okay, let's dig into this. There's this really big headline-making waves. Google is backing Cipher Mining. It involves a massive AI and high-performance computing HPC deal. And Google's getting a stake.
Right.
But what does that actually mean, for crypto investors or even just people watching the space? What's the real story here?
Yeah, it's fascinating because this isn't just like a standard partnership announcement. It feels bigger. It's a real convergence. You've got big tech Google, obviously a giant, making a serious like capital-backed move into physical infrastructure, stuff that was historically just the domain of crypto miners. So our goal today really is to unpack this emerging hybrid model,
Yeah.
how these facilities, originally built maybe just for Bitcoin mining efficiency, are now becoming these dual-purpose hubs for, well, high-demand AI infrastructure.
That hybrid idea, that's the key, isn't it? It feels like a fundamental shift, moving away from, I guess, the sometimes boom and bust cycle of just mining crypto towards being, well, a crucial piece of the global compute infrastructure.
Yeah.
Powering AI and everything else. It's a very different kind of investment story.
It absolutely is. And look, before we get too deep into the numbers and the implications, I think it's really important to set the context right up front for you listening.
Okay.
While Cipher Mining, comes from that pure play Bitcoin mining background, this conversation, it's fundamentally about equities. It's about infrastructure.
Right. Not directly about buying Bitcoin or other tokens.
Exactly. We're talking about a company's stock, its physical assets, its long-term contracts. And with that comes, major financial risks, regulatory hurdles, and maybe the biggest one, execution risk.
Execution risk.
Building
Yes.
out this kind of large-scale infrastructure, especially over a decade, it's incredibly complex, high capital spending. So the potential rewards are definitely there, but they really depend on them delivering almost perfectly.
Got it. So it's a bet on building things, on contracts, not just the price of Bitcoin going up, a sophisticated play. Okay, so let's jump into the core details then. What's the actual structure of this deal between Cipher, FluidStack, and, of course, Google?
Okay, so the heart of it is this really substantial 10-year co-location agreement. Cipher signed this with FluidStack.
FluidStack, they're an AI cloud platform.
Yeah, exactly. They kind of act as an intermediary providing AI cloud services. And the length, 10 years, that signals a serious long-term commitment to hosting this high-performance computing stuff. FluidStack is basically the main tenant here. They'll use this capacity for their clients who need, intense GPU compute power.
Right, okay. And this is where Google steps in directly, financially. It's not just a thumbs up. They're actually putting money behind it or guaranteeing it.
That's the crucial part. Google is essentially guaranteeing or providing critical support for a really significant portion of the financing needed to get this capacity built out and running.
How significant are we talking?
Well, the numbers floating around suggest Google's support could back up to $1.4 billion.
Wow, $1.4 billion. For a company that started in crypto mining, that's huge.
It's enormous. It gives Cipher incredible leverage, credibility. It really de-risks the capital spending for them in a big way.
Okay, so the financing is largely covered or guaranteed. What's in it for Google? Why take on that kind of liability or offer that backing?
Well, two main things, really. First, potentially guaranteed access to that compute capacity themselves if they need it later on. Think of it as securing future supply.
Makes sense in the current AI race.
Exactly. And second, they get equity upside. In return for this financial and strategic backing, Google gets the right to acquire about 5.4% of Cipher. And they get this through warrants.
Warrants. Okay, let's quickly unpack that because that's different from just buying stock now, right? It's an option.
Correct. It's important to understand. Warrants give Google the right, but not the obligation, to buy Cipher stock at a set price in the future.
So they benefit if Cipher does well and the stock goes up.
Precisely. It aligns Google's interests with the long-term success of this whole infrastructure project. If Cipher executes well, builds this out, becomes profitable, and the stock price rises, Google can exercise those warrants and profit.
And for existing shareholders, that means potential dilution down the line.
Yes, that's the trade-off. If the warrants get exercised, more shares are created, which can dilute existing holdings. But, the argument is that securing a partner like Google and that level of financial backing is worth that potential future dilution. It basically confirms Google is invested in the outcome, not just a customer. They're like a shareholder in waiting.
Right. That equity piece definitely shows skin in the game.
Yeah.
Okay, let's talk scale. 10 years, up to $1.4 billion backing. What does that translate to physically? How much computing capacity are we actually talking about?
So the deal, as it stands committed right now, covers 168 megawatts, that's MW, of high-density computing capacity.
168 mega.
Yeah, and this will be housed specifically at Cipher's big site, Barber Lake. To give you a sense of scale, 168 milliW is, well, it's roughly the power consumption of a small city, all focused on running complex AI calculations.
That's already massive. But I think I saw the contract allows for scaling. It's not capped at 168 milliW.
That's right, and that's key to the long-term picture.
Hmm.
While 168 milliW is the starting block, the agreement is specifically structured to allow for expansion.
As AI demand keeps growing.
Exactly. As AI compute needs continue to, well, explode, really, the plan clearly anticipates needing more capacity down the line. So Cipher can potentially build out more, assuming they can get the financing and the power lined up.
It really sounds like Cipher is fundamentally changing who they are. They started as, a fairly straightforward Bitcoin miner, maybe operating data centers. How does this deal force them to change their business model?
It forces a really aggressive pivot. They're moving from what was basically a single revenue stream model tied almost entirely to Bitcoin's price and their mining hash rate.
Commodity-based.
Yeah, very commodity-based, very volatile. They're shifting to a hybrid model, aiming for more resilience. They're combining their Bitcoin mining, which is optimized for, sometimes cheaper interruptible power.
Right.
With this high margin, always-on AI and HPC hosting, which absolutely requires stable, uninterruptible power.
So they need two different kinds of power arrangements almost, maximizing their grid connection and land use.
That's a good way to put it. And to actually deliver on this, we're seeing Cipher move really fast to scale up and upgrade their sites, especially the Black Pearl site expansion.
And that expansion isn't just about adding more Bitcoin miner.
No, not at all. It's about fundamentally upgrading the facilities for HPC. That means things like implementing mandatory liquid cooling because AI GPUs run incredibly hot.
Much hotter than Bitcoin ASICs.
Way hotter. It also means enhanced networking, like high-capacity fiber for super low latency between all those GPUs, and installing specialized high-density server racks. The capital expenditure, the CapEx, is huge, but it's absolutely necessary to service that fluid stack contract and meet Google's standards.
So the infrastructure they built for mining, which could handle power fluctuations, is now being rapidly retrofitted or built alongside infrastructure for the incredibly demanding, always-on world of AI. That's the pivot.
That's the pivot in a nutshell. Yeah.
Okay, let's pull back and look at the bigger picture here. When a tech giant like Google makes a move like this, backing a company rooted in crypto mining, well, the market definitely notices. What does this signal more broadly about this convergence of big tech and crypto infrastructure?
I think Google's involvement is probably the clearest signal we've had so far, that the major tech players, they don't see crypto infrastructure as this weird niche or overly risky thing anymore. They now see real, tangible, long-term value in securing access to this kind of compute capacity. What's happening is the lines are blurring. The boundaries between, say, traditional cloud or AI data centers and crypto mining facilities, they're getting fuzzy.
Why is that? What's the common element?
Because the core scarce resources are actually quite similar. You need reliable, large-scale power, ideally optimized for cost. You need huge plots of land, often in specific locations, and you need the ability to build out and deploy capacity relatively quickly. These are things the crypto mining industry, frankly, got pretty good at.
That makes a lot of sense. It sounds a bit like historical parallels in tech. Like back in the early internet days, telcos or cloud providers would invest heavily in things like dark fiber networks or building massive data centers.
Yeah, exactly. Carrier-neutral facilities.
Right, just to guarantee they had the capacity they needed and could control their own supply chain. This feels like the modern version of that, but focused on facilities optimized for just raw computational power.
It's a really good analogy. And there's maybe an added layer of competition now. In the current AI arms race, securing this kind of power-efficient compute capacity before your rivals do, that's a significant strategic advantage.
So for Google, locking this up, even indirectly through Cipher, is a competitive move.
Absolutely. It builds a moat. And that ties directly into the second big implication for Cipher itself, revenue diversification and hopefully stability.
That seems like the holy grail for miners, right? Pure mining is just so exposed. Your revenue is directly tied to Bitcoin's price if Bitcoin crashes.
The revenue crashes overnight, exactly. For a pure miner, a long crypto winter, a bear market, can be absolutely brutal. It can push highly profitable operations towards insolvency very quickly.
So adding this AI and HPC hosting with these long 10-year contracts, That's the buffer.
That's the strategic goal. Adding these multi-year, often fixed-rate hosting contracts provides that buffer. It moves Cipher towards more stable, predictable, recurring revenue streams. They shift from being just a commodity producer or miner to also being a service provider, hosting.
And the so what for you listening is huge here. If Cipher pulls this off, if they execute well, those predictable hosting revenues could really smooth out their financial performance, especially during those inevitable downturns in the crypto market. That should, in theory, make them a much more attractive investment, particularly for institutional investors who like infrastructure-like returns.
And that potential stability, it gets a massive boost from the third big implication, the signaling effect and the institutional credibility that comes with Google's backing.
Right, the Google stamp of approval.
It's almost priceless, isn't it? When a company like Google effectively says, we've done our homework, we've vetted this operation, and we're willing to put serious financial backing behind it, that confers immense legitimacy. And it's not just legitimacy for Cipher, it validates the whole underlying asset class, these large-scale, power-optimized data centers, and the teams that run them.
And that kind of validation attracts the serious money, doesn't it? The institutional capital, the big lenders, other potential partners, they all see Google's involvement.
Absolutely. It significantly lowers Cipher's perceived risk. And that, in turn, makes it easier for them to negotiate really favorable deals on things like power purchase agreements, PPAs, which are critical for mining and hosting.
Better terms on infrastructure, maybe future contracts.
Exactly. And we've actually seen this play out before on a smaller scale. Remember when SoftBank invested? They bought about $50 million in shares for data center development.
Oh, yeah, I remember that. The stock rallied pretty hard on that news.
It did, just on the confidence boost from a major name investing. Now, the Google deal, it carries way more financial weight, much more strategic importance. The market gravity is just different.
So, okay, we're not just talking about a potentially healthier balance sheet. We're seeing a real shift in the competitive landscape. Cipher is actively trying to redefine itself, moving beyond just being labeled a Bitcoin miner.
Yes, absolutely.
Yeah.
They're explicitly positioning themselves now as a data and compute infrastructure player first. Oh, and by the way, they also happen to run a very efficient mining operation alongside that.
That makes sense.
And crucially, this pivot, it's almost becoming table stakes. It's not unique to Cipher. We're seeing other big miners like Riot Platforms, Iris Energy. They're making similar moves, trying to capture some of this massive demand for AI compute.
So the competition, the arms race in this sector is changing focus. It's not just about who has the most hash power per watt anymore.
That's the core strategic shift, yeah. That metric still matters for the mining side, of course. But the new competitive battleground, it's about infrastructure adaptability. It's about having superior cooling systems, specifically liquid cooling, which is basically essential for these dense AI GPU clusters that throw off way more heat than ASICs.
Right. You can't just use fans for those.
Not effectively at scale, no.
Yeah.
It's also about having top-tier network connections, super low latency. And maybe most importantly, it's about securing huge amounts of reliable power at the absolute lowest possible cost. So for investors, the analysis changes. It's less about predicting the price of Bitcoin and much more about betting on their ability to deploy this infrastructure efficiently, manage capital well, and maintain high operational uptime. It's an infrastructure game now.
Okay, we've painted a pretty compelling picture of the potential upside here. This 10-year vision, Google's backing, it sounds great. But, you know, this is still a really high-stakes game, big money, complex construction. So let's bring in some realism. What are the major risks? What could actually derail this whole strategy? Let's start with the obvious one they can't fully escape: Bitcoin price.
Yeah, you have to acknowledge that. Even with these new, potentially stable AI revenue streams coming online, a really deep, prolonged crypto winter, that could still put serious pressure on their overall margins.
Because the mining part is still a big chunk of their operation, presumably.
Exactly. The profitability of that legacy mining business is still highly sensitive to the value of Bitcoin. And when BTC tanks, miners often face a tough choice. Do they sell the Bitcoin they just mined, maybe at low prices, just to cover their operating costs or debt payments?
Which eats into their reserves and future potential.
Right. It depletes their treasury and limits their flexibility for future growth or handling unexpected issues.
And we've actually seen the market react pretty strongly to just hiccups in their mining output, haven't we? I think Cipher's stock dropped, what, like 17% earlier this year?
Yeah, that was back in March. Reduced Bitcoin production linked to power curtailment, basically. The grid operator asking them to power down sometimes.
So if external things like power availability can hit the mining side that hard, the AI side really needs to perform flawlessly just to balance things out.
That leads us right into probably the biggest single risk factor, execution, and the timelines involved. Building out or converting facilities for HPC hosting. It's incredibly complex. It requires a totally different skill set and operational discipline than just running Bitcoin miners.
Can you maybe elaborate on that difference? Like, what makes HPC hosting so much harder?
Well, think about the supply chain first. For mining, you need specialized ASICs. Okay, they're specialized, but they're established manufacturers. For AI, you need thousands upon thousands of high-end GPUs.
Which are like gold dust right now. Everybody wants them.
Exactly. There's a global shortage, intense competition from Google, Microsoft, Amazon, everyone. So Cipher has to actually get their hands on these GPUs reliably and on schedule to fill that 168 milli-WU. That's a huge logistical challenge.
Okay, supply chain is one thing. What about the build-out itself?
Then there's the physical infrastructure. We mentioned liquid cooling that's expensive and complex to implement at scale. Power stability is critical. AI chips are much more sensitive to power fluctuations than ASICs. Any delays in construction or cost overruns, which are common in big projects, could seriously damage the investment case, especially since the market is probably expecting them to deploy this capacity pretty quickly. So the KPIs you have to watch are ruthless, uptime, power stability, hitting those utilization targets on time.
And beyond the technical challenges of building, there's always the external stuff, right? Like regulations and environmental concerns.
Always. Crypto mining and big data centers already get a lot of scrutiny over energy consumption, carbon emissions, impact on the local grid. Cipher knows how to deal with that.
But AI hosting adds another layer.
It can, yeah. You start dealing with potentially sensitive client data being processed. That brings in stricter regulations around data sovereignty, privacy laws like GDPR or CCPA, depending on the client and data, and general compliance within the specific state or country they're operating in. That might mean higher security standards, more legal overhead.
And all this building, all these upgrades, it costs money. Even with Google's backing helping with financing, Cipher still needs to fund a lot of this themselves, right? Which brings up capital structure risks, maybe dilution.
That's a really critical point for anyone looking at the stock.
Yeah.
Yes, even with the guarantees, Cipher will almost certainly need to raise more capital, probably through debt or issuing more equity, to fund this huge expansion. The most obvious sign of this was that $1.1 billion convertible note they issued.
Right, the convertible note. Can you quickly explain why companies use those and what the risks are?
Sure. A convertible note starts out as debt. Cipher has to pay interest on it. But the key thing is it can convert into company stock later, usually if the stock price hits a certain level or by a certain date.
So it's debt now, potentially stock later.
Exactly. Growing companies like this often use them because it delays the immediate dilution you'd get from just issuing stock right away. It gives them the capital now. But it means they're taking on a lot of debt, a lot of leverage.
And the risks.
Two main ones. First, the debt itself. If interest rates are high, the payments can be substantial. If they take on too much debt, over-leverage themselves, and the revenue from the new hosting business doesn't come online exactly as planned, they could get into trouble. Second, the conversion. If the stock does well, the note holders will convert their debt into stock, which creates a whole bunch of new shares, diluting existing shareholders. So high leverage is a double-edged sword here.
And they're not operating in a vacuum. You mentioned Riot and Iron are also moving into AI hosting. Competition must be fierce.
Oh, absolutely. It's a major threat. Cipher isn't just competing with other miners pivoting. They're up against established cloud giants, AWS, Azure, Google Cloud itself, ironically, and specialized data center operators, especially those maybe located in places with even cheaper power or better natural cooling.
So margins could get squeezed?
Potentially, yeah. Margins in HPC hosting can be competitive. And because Cipher has spent so much on building this specialized infrastructure, they absolutely need to achieve very high utilization rates, keep those expensive GPUs busy very quickly to make it profitable. And there's also the market sentiment risk we touched on. The stock rallied hard on the Google news. A lot of optimism might already be baked into the current price.
Meaning it might be priced for perfection?
Could be. It suggests that any stumble in execution, any delay, could lead to a pretty sharp pullback in the stock price because expectations are already so high.
Okay, one last risk area, internal signals. What are the big shareholders doing?
Yeah, this is always worth watching, especially after big news. You want to see if insiders or major early investors are buying, holding, or selling. And there was a notable transaction recently. A large shareholder, V3 Holding Ltd., sold a significant chunk of shares, about 5.58 million shares.
Hmm. So on the one hand, you have Google backing them, analysts upgrading the stock, but a major holder is selling millions of shares.
Yeah.
How do you square that? Does that worry you?
It definitely adds a note of caution. You have to consider both sides. It could just be standard profit taking. Maybe they got in early, the stock ran up, and they decided to lock in some gains. That happens all the time.
Okay.
But the other interpretation is that maybe some sophisticated investors, people who know the company well, perhaps think the easy money has been made, or that the execution risks over the next, say, 10 years are just too significant for their liking, so they're reducing their exposure.
So it's a conflicting signal for sure.
It is. The public narrative is very bullish, but seeing a large holder sell, it's something you absolutely have to factor into your own analysis. It demands a closer look.
Okay, so this is clearly a complex situation with huge potential, but also significant risks. For you listening, if you want to track this story as it unfolds, what are the really essential things to watch? What metrics tell us if Cipher is succeeding, not just in mining, but in this whole new hybrid model?
Right, you need to track two distinct but related sets of metrics. First, you can't ignore the original business, the operational and mining metrics. That's still generating cash flow, hopefully.
So things like their total hash rate?
Yeah, total hash rate deployed, how much Bitcoin they're actually mining each day or month, usually measured in hash per second, maybe broken down by site. And importantly, look at the efficiency. Are they upgrading their miners? Replacing older, less efficient machines with newer ones. That tells you if the core mining operation's improving or just becoming a drag.
Okay, so keep an eye on the mining basics. But the real story now is the AI and HPC side, right? That's the new thesis. What are the key checkpoints there?
Absolutely critical. Here, the KPIs are all about getting that capacity filled and generating revenue. First, track how quickly FluidStack and any other tenants they might sign up actually occupies that initial 168 mW block.
Utilization rates.
Utilization rates are probably the single most important metric for this new business. Is the capacity sitting idle, or is it humming along at, say, 90% plus utilization? High CapEx businesses like this need high utilization to be profitable. And then, critically, when does the revenue actually start hitting the books? When do they start recognizing revenue from these hosting contracts? Until the cash starts flowing, it's all just potential.
And then we need to see how that new revenue impacts the overall financials, right? Does it actually deliver the diversification and stability everyone hopes for?
Exactly. The absolute key financial metric to watch will be the split in revenue. What percentage is coming from Bitcoin mining versus what percentage is coming from HPC hosting.
You want to see that hosting percentage climb steadily over time.
That's the proof the pivot is working. If that hosting slice of the pie gets bigger and bigger, it shows the strategy is succeeding. Beyond the revenue split, you need to track margins, gross margins, operating margins. Ideally, the margins on hosting should be significantly higher and more stable than the margins on mining.
Okay.
And then, of course, watch the bottom line and cash flow. Track EBITDA trends. Track operating cash flow compared to their capital expenditures. Are they funding operations and growth with recurring revenue now, or are they still relying heavily on debt or selling the Bitcoin they mine?
And speaking of debt, given that big $1.1 billion convertible note, tracking their capital structure seems vital.
Essential. You have to monitor their total debt levels. Keep an eye on the interest expense. How much are they paying just to service that debt? Right. And check their liquidity. How much cash do they have on hand to handle unexpected delays or costs?
And leverage ratios.
Yes, especially leverage ratios like net debt to EBITDA. Compare those ratios to their peers in the industry. Are they taking on significantly more debt than others making similar moves? Ideally, you want to see those leverage ratios start to trend down as the new hosting revenue starts coming in and contributing to EBITDA. That shows they're managing the growth responsibly.
Okay, and finally, how is the market itself reacting? Stock performance? Sentiment? What should we look for?
Yeah, watch the stock price, obviously. Look at how it reacted to the big announcements, the Google deal news. When they announced the Black Pearl site was energized, did it spike and then pull back?
Analyze the chart.
Right. Also, watch for changes in short interest. Are more people betting against the stock? Look at trading volume spikes. And keep an eye on analyst ratings. We mentioned I already upgraded them to buy. Are other analysts following? What are their price targets? But always take those with a grain of salt.
And the key question underlying all that is
the market getting ahead of itself? Did the price run up too fast on the initial excitement, creating a valuation that the company now has to work really hard to justify through flawless execution? That's the risk of priced-in optimism.
And comparing their valuation to peers like Riot and Iran gives context.
Crucial context. Look at their valuation multiples, things like enterprise value to revenue, EVR, or EV to EBITDA. How do those compare to Riot, Iron, or other data center players? Is Cipher trading at a big premium just because of the Google name? If so, their execution needs to be demonstrably better to warrant that higher valuation. It tells you where the market is placing its bets. Hashtag outro show. So just to wrap up the main strategic points here, look, the Google backing, this huge 10-year HPC contract, these are genuinely powerful signals. They fundamentally reposition Cipher in the market. It's a potential pivot point, setting them up for maybe greater resilience, more predictable growth like an infrastructure company. But, and it's a big but, realizing that potential, it absolutely depends on really three things. Flawless execution on building out and upgrading sites like Black Pearl, getting that 168 MW of capacity filled up quickly, high utilization, and maintaining really tight control over costs throughout this whole 10-year period.
So for you listening, if you're looking for that kind of hybrid exposure, a mix of physical infrastructure assets plus some crypto upside, CIFR, Cipher stock, it offers that blend. But let's be really clear, right?
Absolutely. This is still a high volatility, speculative investment, especially with that large convertible debt load hanging over them. It really should be treated more like a moonshot potential type of bet. Requires a lot of homework, ongoing monitoring, and caution. It's probably not something for a core, conservative, long-term portfolio.
Right, needs careful consideration.
And maybe one final thought for you to track personally, the next quarterly earnings report, that's going to be a really important moment. Keep a close eye on that release to see if those AI and HPC revenues are actually starting to show up in a meaningful way. Are they beginning to genuinely displace or at least significantly add to the volatile mining revenue? That tangible proof, seeing that recurring hosting revenue hit the income statement. That's everything for this story right now.
That's the #1 thing to watch for. Okay, so that brings us to the end, but we want to hear from you. What do you think? Does Google's backing make Cipher feel like a safer bet because of that financial muscle? Or do you think this is mostly just hype around AI and crypto coming together, maybe masking some really deep execution risks?
Yeah, and which side of the business do you trust more for the long term? The established but volatile mining promise, or this new, potentially more stable but unproven AI hosting promise? Let us know your thoughts.
We covered a ton of ground today. I mean, from liquid cooling specifics and GPU supply chains, all the way to the details of warrants and convertible debt. If you found this deep dive helpful, if you feel like you understand this Google Cipher situation better now, please do us a favor. Hit that subscribe button, maybe leave a comment with your thoughts below, and definitely ring that notification bell.
Yeah, seriously, engaging with the content, subscribing, commenting, liking it, genuinely helps support us, helps the channel get seen by more people in the algorithm.
And that allows us to keep doing these deep dives, bringing you quality analysis on crypto, infrastructure, and all these fascinating intersections. So thanks again for diving in with us today.